Now, sorry to say, but for personal reasons, the Vice President is absent from today's press conference. So, ladies and gentlemen, I'm very pleased to welcome you to our press conference. And I'll now report on the outcome of today's meeting of the Governing Council. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. Incoming information and analysis have further underpinned our previous assessment. Underlying price pressures in the euro area are expected to remain subdued over the medium term. In keeping with this picture, monetary and in particular credit dynamics remain subdued. Inflation expectations for the euro area continue to be firmly anchored in line with our aim of maintaining inflation rates below but close to 2% over the medium term. At the same time, real GDP growth in the second quarter was positive, after 6 quarters of negative output growth, and confidence indicators up to August confirm the expected gradual improvement in economic activity from low levels. Our monetary policy stance continues to be geared towards maintaining a degree of monetary accommodation warranted by the outlook for price stability and promoting stable money market conditions. It thereby provides support to a gradual recovery in economic activity. Looking ahead, our monetary policy stance will remain accommodative for as long as necessary, in line with the forward guidance provided in July. The Governing Council confirms that it expects the key ECB interest rates to remain at present or lower levels for an extended period of time. This expectation continues to be based on an unchanged overall subdued outlook for inflation extending into the medium term, given the broad-based weakness in the economy and subdued monetary dynamics. In the period ahead, we will monitor all incoming information on economic and monetary developments and assess any impact on the medium-term outlook for price stability. With regard to money market conditions, these have also been influenced by a gradual reduction in excess liquidity. Repayments of funds taken up in the context of the 3-year longer-term refinancing operations reflect improvements in financial market confidence, some reduction in financial market fragmentation, and the ongoing deleveraging by euro area banks. We will remain particularly attentive to the implications that these developments may have for the stance of monetary policy. Let me now explain our assessment in greater detail, starting with the economic analysis. Following 6 quarters of negative output growth, euro area real GDP rose quarter on quarter by 0.3% in the second quarter of 2013. This increase is partly explained by transitory effects related to weather conditions in the first half of this year. Since then, survey-based confidence indicators up to August have improved further from low levels, overall confirming our previous expectations of a gradual recovery in economic activity. Looking ahead to the remainder of the year, and to 2014, in line with our baseline scenario, output is expected to recover at a slow pace, in particular owing to a gradual improvement in domestic demand supported by the accommodative monetary policy stance. Euro area economic activity should, in addition, benefit from a gradual strengthening of external demand for exports. Furthermore, the overall improvements in financial markets seen since last summer appear to be gradually working their way through the real economy, as should the progress made in fiscal consolidation. In addition, real incomes have benefited recently from generally lower inflation. This being said, unemployment in the euro area remains high, and the necessary balance sheet adjustments in the public and private sectors will continue to weigh on economic activity. This assessment is also reflected in the September 2013 ECB staff macroeconomic projections for the euro area, which foresee annual real GDP declining by 0.4% in 2013 and increasing by 1% in 2014. Compared with the June 2013 Eurosystem staff macroeconomic projections, the projection for 2013 has been revised upwards by 0.2 percentage points, largely reflecting incoming data. For 2014, there has been a downward revision of 0.1 percentage point. The risks surrounding the economic outlook for the euro area continue to be on the downside. Recent developments in global money and financial market conditions and related uncertainties may have the potential to negatively affect economic conditions. Other downside risks include higher commodity prices in the context of renewed geopolitical tensions, weaker than expected global demand, and slow or insufficient implementation of structural reforms in euro area countries. According to Eurostat's flash estimate, as expected, euro area annual HICP inflation was 1.3% in August 2013, down from 1.6% in June and July. On the basis of current assumptions for energy and exchange rate developments, annual inflation rates are expected to remain low in the coming months, owing in particular to energy price developments. Taking the appropriate medium-term perspective, underlying price pressures are expected to remain subdued, reflecting the broad-based weakness in aggregate demand and the modest pace of the recovery. Medium to long-term inflation expectations continue to be firmly anchored, in line with price stability. This assessment is also reflected in September 2013 ECB staff macroeconomic projections for the euro area, which foresee annual HICP inflation at 1.5% in 2013 and 1.3% in 2014. In comparison with June 2013 Eurosystem staff macroeconomic projections, the projection for inflation for 2013 has been revised upwards by 0.1 percentage point, while the projection for 2014 remains unchanged. The risks to the outlook for price developments are expected to be broadly balanced over the medium term, with upside risks relating in particular to higher commodity prices, as well as stronger than expected increases in administered prices and indirect taxes, and downside risks stemming from weaker than expected economic activity. Turning to the monetary analysis, data for July confirmed that underlying broad money, M3, and in particular credit growth, remained subdued. Annual growth in M3 decreased further in July to 2.2% from 2.4% in June. Annual growth in M1 remained strong, but decreased to 7.1% in July from 7.5% in June. M3 growth continued to be mainly supported by net capital inflows in the euro area, while the annual rate of change of loans to the private sector weakened further. The annual growth rate of loans to households remained at 0.3% in July, broadly unchanged since the turn of the year. The annual rate of change of loans to non-financial corporations was minus 2.8% in July, compared with minus 2.3% in June. Weak loan dynamics continue to reflect primarily the current stage of the business cycle, heightened credit risk, and the ongoing adjustment of financial and non-financial sector balance sheets. Since the summer of 2012, substantial progress has been made in improving the funding conditions of banks, and in particular in strengthening the domestic deposit base in a number of stressed countries. In order to ensure an adequate transmission of monetary policy to the financing conditions in euro area countries, it is essential that fragmentation of euro area credit markets declines further and that the resilience of banks is strengthened where needed. Further decisive steps to establish a banking union will help to accomplish this objective. To sum up, the economic analysis indicates that price developments should remain in line with price stability over the medium term. A cross-check with the signals from the monetary analysis confirms this picture. In order to further reduce imbalances and to foster competitiveness, growth, and job creation, euro area countries need to continue with their reform agenda. As regards fiscal policies, governments should not unravel their efforts to reduce deficits and put debt ratios on a downward path. The composition of fiscal consolidation should be geared towards growth-friendly measures which have a medium-term perspective and combine improving the quality and efficiency of public services with minimizing distortionary effects of taxation. In terms of economic policies, product market reforms to increase competitiveness will facilitate the creation of new businesses, support the tradable goods sectors, and foster job creation, while high unemployment rates require decisive structural reforms to reduce rigidities in labor markets and to increase labor demand. I'm now at your disposal for questions.
Jeff Black, Bloomberg, please.
Thanks a lot. Good afternoon. Sorry, I have to peer around to be able to see you. You mentioned that if excess liquidity declines much further, you'd be particularly attentive to developments in that regard. So could you help us by perhaps indicating at what point numerically excess liquidity becomes a concern to you and what then you would do about that? And my second question is about the renewed tensions in the Middle East. If it transpired that there was an oil price spike, which has happened in the past, of course, does that endanger your forward guidance outlook, or would an oil price spike be something that you would be inclined to look through? Thank you.
Thank you. You are absolutely right to have focused on that sentence, particularly attentive. Right now, we view the current excess liquidity as adequate, but we stand ready to act. Now, we've got to be aware that excess liquidity depends on two factors. The less fragmentation, the less is the excess liquidity. And the second factor is our reaction to the excess liquidity and to the demand, namely through LTROs. So now we are down from 800 billion to 250 in terms of excess liquidity, and that's all in all good news, because it means that fragmentation has been receding. Now, when we come to the relation between the excess liquidity and the IONIA rates, which is what you are really asking, we have to consider that this relation is unstable in the sense that there isn't any precise figure. I remember some time ago I've mentioned the figure of 200 as the figure, as the threshold, but in fact it's really context depending. It depends on the context. It depends on the degree of fragmentation that we have. The ECB bulletin speaks of a figure between 200 and 100. But in general, the threshold depends on the state of fragmentation. The other caution that I would make is that one should not extrapolate too much from the past repayments pattern of LTRO. As you've seen, the figures, it's been quite significant for some time, and now it's basically constant. So it really depends on who's repaying the LTRO. What is the state of their funding conditions? What is the state of their profitability? What is in general their situation? So I wouldn't extrapolate repayment pattern too much as saying that, say, in a month's time, this 250 figure will go down to 200 or whatever. And second, I would say that there isn't any stable relation between the figure and the threshold and the rates. In any event, we would, as I said, we would stand ready to take appropriate action as needed. And obviously, I will already said this several times, we have the fixed rate full allotment policy in place until at least July 2014 and for as long as needed. On the second question, well, we have to see really. But in general, we look at, our reference is at the HICP inflation. So we have to see whether this would alter our medium-term forecast for inflation. As I mentioned before, risks to inflation are broadly balanced, and one of the risks is exactly shocks in commodity prices, one upward risk. So we will have to assess. But the rate to which we look is the headline inflation. Thank you.
Reuters, please.
First question is whether you have discussed a rate cut today. And second question is on market interest rates. You raised concern about the level of the market interest rates in July, and would just wonder whether you feel comfortable with the level right now.
Thank you. On the interest rate cut, there was a discussion like we do all the time. So, we discussed the state of our monetary policy stance at each point in time. We discuss interest rates and other monetary policy instruments. Some governors, of course, observed that improvements in the economy would not justify this discussion. But several other governors observed that, on one hand, the recovery is still too green. If you look at that, slack is still wide, weak credit, weak money aggregates, inflation is subdued in the medium term, unemployment is still high. So it was too green to exclude this discussion, And if money market developments, and here I'm answering to the second question really, if money market developments were to be judged unwarranted in their impact on our assessment of medium-term inflation, then such an instrument should be considered. Thank you.
Brian Blackstone. Wall Street Journal, please.
Brian Blackstone with the Wall Street Journal. Just on that second answer you gave, last month you said that the rate hike expectations embedded in the money markets were unwarranted. Is that still your assessment? And if it is, then why didn't you cut rates today? And my second question more broadly is there a risk that the ECB is trying to fine-tune the markets too much? Is there anything wrong, given the context of the Eurozone and the global economy, for investors to say a couple years down the line there might be a single rate hike from crisis low, near zero levels? Thank you.
Thank you. Interest rates move for a variety of reasons. Some of them have to do with the news related to the improvements in the economy. In this case, the forward guidance we have expressed is just geared to make sure to reach two objectives. The first is to reduce the volatility within the corridor, which we have succeeded. The second objective is to make sure that this news relative to the improvements in the economy do not cause overreaction in the market interest rates. And on that ground, we have been moderately successful. And I would refer for an analysis and a comparison of different forward guidance concepts to a very recent and very interesting paper by the Bank of International Settlements. Then there is another set of news that comes that has nothing to do with the euro fundamentals. It may come from all over, in which case the forward guidance is meant to make sure that you want to look through this news to make sure that their impact on the medium-term assessment of inflation is contained. So I would say that's the answer.
Hella Huck, please, RTL Nederland.
Well, Europe is picking up, but the Netherlands is still in recession. And the Dutch people think that's because of austerity measures. What do you think is the main reason that the Dutch economy is lagging behind? My second question would be that there are new austerity measures coming up, 6 billion. 1/3 will be tax increases. Do you think that the Netherlands is on the right track to recovery? And I know I'm stretching it a bit, but I have a third question. Dutch government has decided not to privatize ABN AMRO for another year. 2 of our 4 big banks are nationalized. I was wondering in general what your vision is on state ownership of a bank. What does that do to the competitiveness of the sector?
Before we answer, we have a rule of 2 questions. So would you please pick the 2 most important ones?
The first 2.
Thank you.
Now, I'll say this, the Netherlands is undergoing a protracted domestic demand-driven recession. And you know that the household sector is heavily indebted. There are financial sector challenges, declining real estate prices, and all this weighs on domestic demand. So in this environment, the leveraging by the households and by the banks is natural. However, the recent data show a decelerating pace of the contraction with some signs of recovery in business investment and some stabilization of exports. So there are also positive signals coming from the latest survey. The industrial confidence has improved in recent months. The manufacturing PMI has climbed into positive growth territory. So I would expect a gradual pick-up of the economy. However, the medium-term outlook remains subdued as with other members of the euro area. Now, what are the most important reforms the Dutch government ought to do? It's not up to me, really. It's up to the Dutch government to decide on the importance and urgency of reforms. In the context of the European semester, the Council has adopted country-specific recommendations, which we fully support. And these recommendations concern a correction of the excessive deficit by 2014 and the implementation of further reforms in the housing market, in the pension system, the health and long-term care sector, and the labor market. Thank you.
Domenico Conti, answer, please.
I have a couple of questions. My first question is on the single supervisory mechanism for banks. I would like you, Mr. President, to tell us about the recent developments of the ongoing discussion with the European Parliament on the SSM. And second, about measures regarding banks. Again, there were some measures that were announced in July, for instance, to ease ABS haircut and raise it on written covered bonds, but there were some legal hurdles to be crossed on this regard, and other measures regarding mezzanine credit for small and medium enterprises. Can you give us a flavor of what the state of the art is as regards these issues? Thank you.
Thank you. On the SSM, our discussions with the European Parliament progressed considerably, and we should have some news in the coming days, some positive news in the coming days. Next to this, the preparation for the creation of the SSM is continuing, and it works well. As I remarked on other occasions, there is a sense of by all the national supervisors there is a strong, I would say, cooperative stance. So the working atmosphere is actually very, very good. There will be a full communication, a first full communication on the assets, what's so-called the asset quality review, which in fact is a risk assessment, is a balance sheet assessment, by mid-October. I think that is one of the communication that I think is most important, because especially by the banking system, which is going to be the recipient of the SSM action, it is a highly welcome to know how things will be done in the coming months. On the other front, the ECB continues to work with EIB and with the Commission in an advisory role, and we will report on this, and we will see what is the space, what is the room for the ECB to act on this front once the work is completed. Thank you. Certainly before year end. But we have to keep in mind that one thing is the design of what can come out of this effort. Another one is the overcoming of the regulatory hurdles, which make the use of ABS quite difficult at the present time.
Claudia Arbeitsol, then ZZ.
Neue Zürcher Zeitung. Mr. Draghi, but have the exact criteria for the balance sheet assessment already been defined by the Governing Council? And if so, what is the outcome?
No, as I said, we're going to have a full communication mid-October. So for the time being, I can only tell you that people are working. There are many people who are working on this. All the 17 national supervisors and their teams and the ECB are working on this. There isn't any anything that I can report precise that I can report at this stage on this.
Tonia Mastrobuoni, La Stampa.
Mr. Draghi, a follow-up to the question on banking union. Yesterday, Mr. Asmussen said very explicitly that if a bank should be resolved, this should be decided by the ECB and implicitly not by the European Commission. I wonder if you agree with this position, which is a very, very clear position. And my second question is on Greece. There has been a discussion, especially in Germany, about an eventual third package of for after the elections. I wonder if the ECB has the same opinion that Greece will need help again.
Now, on the first point, I think there has been a misunderstanding. I don't think Mr. Asmussen has ever said that, and there has been confusion. The view that we have is the following. The supervisor makes the assessment. And that's, by the way, how things usually go in most member countries nowadays. The supervisor makes the assessment in total independence and then hands this assessment to the resolution authority, which nowadays in many member countries is the government. And then the government decides what they want to do. The supervisor cannot decide what they want to do, whether to resolve the bank or sell the bank or whatever. It's not its responsibility. And Mr. Asmussen said this. So he's been I think, misinterpreted. So there is no confusion here. The line is pretty clear. And by the way, we've seen also that there was again a misunderstanding, saying that the Bundesbank would think Bundesbank agrees 100% with this view. So, and that's by the way, this is how supervisors work in all countries. Supervisors can't have responsibilities that pertain or may pertain to the taxpayer. So the supervisor makes the assessment, hands the assessment, saying, look, this bank is not viable under present circumstances. You have to do something, but it's up to you to decide what to do. So that's pretty clear. Sorry, on the second point on Greece. Now, I can say that the current adjustment program for Greece expires at the end of 2014. And this leaves some time for the Eurogroup to decide on possible extension of the current program and to assess prospects for Greece to regain access to capital markets. So it's also quite straightforward, the fact that if an extension of the program is needed, it will require further conditionality.
Susanna Lynch, The Irish Times.
Hi, I just have a specific question regarding Ireland. It intends to be the first country to exit a bailout at the end of this year. Do you think it will need a precautionary credit line?
Well, in Ireland, I would say program implementation is on track. Recent fiscal data have been overall positive. Market sentiment continues to improve. Challenges remain, especially in the financial sector. About the possible successor program, a decision will be taken in due time. Now, a key consideration is that conditions remain for a successful conclusion of the current program. And I should say that Ireland is leading the way in this respect. So it will be key to ensure that the appropriate framework is in place to safeguard the achievements made and to avoid potential risks to full market access once the program is completed.
It's just that, quick follow-up. Just as you said there in the previous question, Greece had a whole other year until the end of 2014 for its programme to finish. But in Ireland, we're talking about a couple of months. So when do you think it's imperative that a decision is made on a strategy for exiting the bailout quite soon, in the next 2 months?
Well, yes, that's up to the Eurogroup to decide. Thank you.
Jack Ewing, International Herald Tribune.
Jack Ewing, International Herald Tribune and New York Times. And not to hammer too much about Greece, but there's also been a lot of talk about whether there should be some kind of debt relief. And I wonder if I could just push you a little bit more on that, and whether there's anything you can say about whether that's something the ECB would consider in light of the fact that you're major holders of Greek bonds. Thank you.
Well, the answer is no. I mean, it's pretty. We've gone. You remember? I don't know whether you remember. We've gone through this when we had the discussions about Greece almost about a year and a half ago, and it's pretty clear that we cannot do monetary financing. Article 1, 2, 3 of the treaty forbids the ECB from doing monetary financing.
Marika De Feo, Corriere. Can we have a microphone here?
Thank you. There are some critical voices who say that the ECB is responsible for the crisis of some saving banks because of the low interest rates, and which, by the way, contribute also to the expropriation of savings. Could you please answer to this, because it is very much debated here, especially here in Germany. And then the well, I had so many questions. I'm sorry. Is the ECB reflecting over the fact that with high debt and weak and countries coming out weak from recession, a midterm inflation target is not enough to get out of the crisis? And there are some economists who suggest that you link it to, like the Fed, to also to unemployment.
Well, the answer to the second question is pretty straightforward. Our mandate talks about price stability, and that's our objective, price stability in the medium term. On the first point, as you know, as I've said many times, the ECB sets rates for the whole of the euro area. Second, we see no inflation in Germany. Third, interest rates. Now, are interest rates low because of ECB's rates are low? Well, the answer is just look at what happened to the interest rates on the 10-year Bund in the last month or so. It went up by about 50 basis points to slightly less than 2%. And our rates were simply the same, or even actually they were cut a month and a half ago about. So this relation between our rates and rates on the bonds has to be looked quite close, and it's not at all in one relation. As a matter of fact, there is another factor that plays into keeping interest rates artificially low in Germany and the Netherlands, and in some other countries as well. And that's the fact that we had fragmentation, and these countries have become the safe haven for the euro area. So you have flows. You had, for about 3 years now, we had flows pouring into these countries and keeping interest rates artificially low. So everything we've done for reducing fragmentation actually contributes to higher and more realistic rates in these countries. And this should be acknowledged.
Rolf Benders, Handelsblatt.
Mr. Draghi, I've got two questions. One is related to what you announced last time on this press conference, that you would put forward a proposal on minutes, and I would like to hear whether something like this was discussed and what the state of this discussion is. The second question is on German politics. Are you watching the outcome of the general elections coming this month? And do you think that this can have an impact on the economy?
Well, on the second question, I have to give you a very general answer. Often elections have an impact on the economy, but I can't comment on the specifics of this election. On the first, actually, if I'm correct, I didn't use the word minutes. I think I used the word an account of our discussions, and work is going on. Is going on, and and as I said, it's quite important. It could be if it's well done, it could actually give more light and transparency on the nature of our discussions. But it's quite important to acknowledge that our setup, our institutional setup, is not the same as the US or the UK or Japan. We are a 17 countries monetary union. And so the governors are there in their personal responsibility, and they should remain independent in their decision making. And so anything that would threaten their independence would not be acceptable. So transparency while keeping their independence.
Can we expect some news on this one, like this year?
We said, yes, I think I did say that the executive board will present a proposal in the fall.
Claudia Perez, El País.
Hi, this is Claudia Perez from El País. The Spanish program for the banking system is going to expire in the next January. Do you support an extension for the program or another form of backstop or insurance for the Spanish banking system?
Well, I mean, the financial assistance program is fully on track. Banks have been recapitalized. Their restructuring plans have been implemented. The non-performing assets have been transferred to Sareb, and Sareb has already started selling some of the assets. The deleveraging process is going as expected. Some banks have made steady progress in reducing their dependence on wholesale funding and on the euro system. As you know, Spanish banks have repaid a substantive amount. So the reform of the savings bank has been comprehensive. So there are a few issues that remain, but they are likely to be resolved without any major impact on the liquidity or solvency of the Spanish banks. Thank you.
Jeff Cutmore, CNBC.
Thank you very much, Jeff Cutmore, CNBC. While I don't want to over-dramatize what's going on at St. Petersburg, the market has become quite sensitive to news flow over Syria. So that is one of the potential geopolitical downside risks that you've acknowledged, I think. In the medium term, there is also a growing concern about the emerging market slowdown and the deficit currencies. So my two-pronged question really is, what specific responses have been discussed within the Governing Council to ease any market distress on either of these issues? And my second question is, have you spoken or communicated with the Federal Reserve or other central banks about the prospect of coordinated action should it be necessary? Thank you.
Thank you. We certainly are alert to the geopolitical risks that may come out of the Syrian situation and to the economic risks that may derive from the emerging market situation, which are two different things, really. From this point, I should say something I should have said before. When we look at the nature of the composition of the this sort of beginning of a recovery. As you observe, I'm very, very cautious about the recovery. I can't share enthusiasm. It's just the beginning. Let's see. These shoots are still very, very green. I should have said one thing, that for the first time in about 2 years, it's domestic demand that is at the root of this recovery. It's still coupled with exports, but it's domestic demand. That's very important, because it kind of gives a sense that if it continues, it gives a sense that the dependence of the recovery on the rest of the world is somewhat balanced by domestic demand. Also, but let me say, so this is one thing. Second thing, we certainly stand ready to act. I did say this when I was asked about what we do about it if interest rates develop or money market developments were unwarranted in view of our assessment of medium-term price stability. And we certainly, and as I said before, we stand ready to act, whether these developments derive from one source or another. I've commented on that before. We haven't yet discussed any coordinated action. And we have periodic exchanges anyway. One of them will be, by the way, this weekend in Basel. There will be an opportunity for a meeting with central banks of major countries.
Michael Steen, FT.
Michael Steen, FT. Mr. Draghi, was there any discussion today on the Governing Council about a more explicit version of the forward guidance you've got? Might invite you to use that. You seem to be dipping your toes into giving us a fuller account by talking earlier about various governors saying this and that. And so if you could answer the question that way, that would be brilliant. And second question is, as a former Amsterdam correspondent, I enjoyed your answer about Holland just now. I was wondering, could you give us a similar sort of tour d'horizon about the situation in Italy, or is that a country you fundamentally won't talk about? And I say that because our Italian colleagues don't seem to be here today. Thank you.
Thank you, Michael. I mean, I rather, on the second question, rather not comment. It's kind of, you understand why, I think. So I think you had to rely on someone else to have this tour d'horizon for Italy. But on the first question, we have reflected, of course, on the nature of our forward guidance. And we've asked ourselves what are the objectives of the forward guidance. The forward guidance contains an assessment by the central bank about its view of the future and contains information about the central bank's policy response for the future. I think that's the essence of forward guidance. It's not a change in our reaction function, but it's rather an explanation of our reaction function. We want it to be clearer. We don't want to change it. Now, forward guidance are of two types. One is qualitative, and the other ones are quantitative, with precise state conditions. And ours is of the first type. So, all in all, the Governing Council is fairly compact, unanimous actually on this point, on the wish to maintain this type of forward guidance. We are also, I mean, if we look, I mentioned before to this paper by the BIS, where they actually compare the results and the sort of successes of different types of forward guidance. And as I said before, the ECB doesn't score too badly. It scores very well on having controlled volatility and reduced the uncertainty within the corridor. And it scores okay in controlling the levels of rates. But as I said, there are many continuous flow of news on the rates. So, given our specific institutional setup, the qualitative forward guidance that we've used is the most appropriate. And you can easily see why a different forward guidance will create problems for within our institutional setup, if we were to be willing to adopt a precise formulation, a quantitative formulation, which we are not.
Just one small follow-up then. If there's no change in the reaction function, does that mean that essentially you would do nothing different if there was no forward guidance?
No, because we basically said that looking at the medium-term outlook for inflation, so way beyond the short term, we wanted to make clear that we have a downward bias in interest rates for an extended period of time. And I think that is the essence. And we never said that before. So the very fact of saying it is by itself a very powerful clarification of our reaction function. Thank you.
Mark Schreurs, Börsenzeitung.
Yes, thank you. The first one is also on forward guidance, but on a different issue. In July, you said that at the end of the press conference that you would all agree that low level of interest rates entail serious risks to financial stability. But there is no reference to financial stability in your forward guidance, while, for example, the Bank of England explicitly mentions such risks as one of the 3 knockouts for its forward guidance. So the question is, why is there no mentioning of financial stability risks in your forward guidance? And to be more precise, what would happen, or what would be the reaction of the ECB if such risks emerge while the medium-term inflation outlook is very subdued still? And the second question is just on the resolution issue, just to clarify. You said that the ECB will make an assessment and hands it to the governments, let's say, if this is the resolution authority, and it's up to them to decide. Does that mean we can get into a situation where the ECB says, okay, this bank is a case for resolution, but the authority says, no, we differ from this kind of view, and what would happen in that case? Thank you.
Thank you. The second question is the practice in, I would say, almost all, if not all, the supervisors in the euro area is the following. It's the supervisors who look at the viability of a bank in a certain situation. If they were to decide that the bank is not viable, then they would simply communicate this to the authority, which has the responsibility to, well, first of all, there is what's called supervisory action. Namely, the bank would be asked to raise capital, to sell assets, to do bail-in, and so on, to do all these things. But suppose you have exhausted all these things, or you simply judge that the bank is unviable no matter what. Supervisory action could be undertaken. In that case, you hand it to the resolution authority, which often is the government, but often is separate. In our proposed legislation will be a separate entity, whether it's the Commission or another authority isn't clear yet. And they will decide what to do, because it's up to them, because they may be using public money, or they may be considering that the further bail-in could be feasible. So, but the assessment, and not how to, I would say the assessment is made by the supervisor. The actions required to respond to this assessment would be decided by the independent authority. I think that's pretty clear, and that's been the view of the ECB. And so that's one question I think I've answered. Oh, the second question is about financial stability. The issue is, first of all, financial stability risks are often addressed by macroprudential tools. So that's what we have in mind, and it's actually part of the SSM creation. We don't view now movements in interest rates as a realistic way to respond to risks in financial stability that we don't see. In other words, we don't see risks to financial stability that may derive from the too low level of interest rates at the present time. But certainly, if there were a situation like we had in the past, we would have to think about and react. But in the past, we didn't have this medium-term outlook of inflation so subdued as we are watching now.
The gentleman at the back.
With respect to the policy of forward guidance and the challenge that central banks face in keeping the credibility with the marketplace, I wonder if you could speak to whether the Governing Council has given consideration to...
What do you think is?
Pardon me?
I'm sorry, can you repeat the question?
Yes, I wonder if you could speak to the consideration, if at all, the Governing Council has given to ways in which to cement the forward guidance, particularly perhaps releasing inflation forecasts into 2015 or other methods that might give the market more comfort with respect to the forward guidance, given the market differential that we're seeing, not only for yourselves, but for other central banks?
I think that's a legitimate question, and the forecast for 2015 inflation will be published at year end, so on the occasion of the next projections.
Thank you. The last question to you.
I'm Nobusunaga from Jiji Press, Japanese news agency. My question is on OMT. Just 1 year ago, you announced the detail of these measures at here. What's interesting for me is that why this measure is so effective without being activated. Other central banks, for example, Bank of Japan or Fed, have introduced similar programs, but they need to activate it to be effective. So my question is, why only in Eurozone such program is effective, even without being activated? Thank you.
Well, it's very hard to answer this question without flattering oneself. But I suspect that it's the design of this has made this measure both powerful and credible. It's powerful because it addresses a realistic objective, which is the redenomination risk spreads, the spreads that derive from redenomination risks. It's credible because it is accompanied by conditionality. In our present context and in many others, I suspect, the commitment to buy an infinite amount of bond in order to keep interest rates at a certain level is often not credible, besides being, in our present context, illegal. So I think these two combinations of a realistic target accompanied by in principle, unlimited amount of means, in fact, limited by the market size, and by conditionality, has made this measure very effective without need to be activated. But conditionality is an important ingredient because it says that once this measure is being activated, the country that is receiving, it's on the receiving end, is actually undertaking a series of actions, budgetary consolidation or structural reforms or both, that have as a consequence they have the result of increasing the value of the bonds issued by this country. And the value of the bonds are exactly what the ECB is buying into it. So the conditionality, if properly activated, produces an increase in the value, if you want to use this word, of the collateral that the country posts in exchange of the ECB action. I think that's a way to think about this. But anyway, thanks for asking.